The current outlook for the micro-private capital market, a 6-9-month view. The micro-private capital market occupies an awkward but fascinating corner of the financial universe. It is neither the glamorous playground of billion-dollar private equity titans nor the scrappy, hoodie-wearing chaos of seed-stage venture capital. Instead, it lives somewhere in between, small enough to be personal, large enough to be stressful, and just complicated enough to keep everyone permanently busy while convincing themselves they are being strategic. In recent years, this market has experienced a peculiar combination of heightened interest, chronic frustration, cautious optimism, and low-level existential dread. Capital has become more expensive, deals have become harder to close, founders have become more defensive, investors more selective, and advisors more verbose. Everyone is leaning in, but nobody is quite sure what they are leaning towards. This essay explores the current outlook for the micro-private capital market, what it is, where it stands, what pressures it faces, and how it might evolve. It will do so without external links, without breathless hype, and without pretending that anyone really knows what interest rates will be doing in 18 months' time. There will be some humor, because without humor one might otherwise scream. Defining the micro-private capital market, without starting a fight. Before discussing outlooks, trends, or existential threats, it is worth clarifying what is meant by micro-private capital. This is not as simple as it sounds, because if you put 3 practitioners in a room you will get at least 4 definitions, one of which will be wrong but loudly defended. For the purposes of this discussion, the micro-private capital market generally refers to equity or quasi-equity investments below roughly £10-20 million enterprise value. Often founder-led, owner-managed, or family-influenced businesses. Typically profitable or near profitable, but operationally messy. Often underserved by institutional capital. Regularly overestimated by founders and underestimated by spreadsheets. This market includes micropay, search fund-style acquisitions, permanent capital vehicles, family office investments, minority growth capital, and the occasional optimistic hybrid structure held together by preference shares and hope. What unites these deals is not size alone, but texture. These are businesses where the management accounts are directionally accurate, the CRM system is a whiteboard, and the founder knows every customer by name but not necessarily their gross margin. They are deeply human enterprises, and therefore deeply unpredictable. Macro conditions, the weather has turned, and everyone brought the wrong coat. The micro-private capital market does not exist in isolation. Like all financial ecosystems, it is shaped by broader macroeconomic forces, even if its participants insist they are bottom-up thinkers. Over the last few years, the market has had to adjust to higher interest rates, tighter credit conditions, reduced appetite for speculative growth, increased cost of leverage, a general sense that money is no longer free, and might even expect something in return. For micro deals, this has had an outsized impact. Leverage, once a friendly tailwind, has become more expensive and more conditional. Senior lenders are more cautious, mezzanine lenders are more selective, and anyone describing themselves as flexible now comes with a term sheet that suggests otherwise. As a result, deal structures have shifted. More equity is required, returns must work harder, and underwriting assumptions are being interrogated with an enthusiasm previously reserved for suspicious house purchases. This is not necessarily a bad thing. In fact, it may be long overdue. But it does mean the easy years are over, and the market is relearning some old disciplines it had temporarily forgotten. Valuations, reality has entered the chat. One of the most noticeable changes in the micro-private capital market has been the recalibration of valuations. For a while, even very small businesses became convinced they were on a multiple journey, often without quite knowing where the journey was heading. Today, the mood is more sober. Valuations have softened, particularly for businesses that rely heavily on a single founder, have weak second-tier management, are exposed to discretionary consumer spend, lack demonstrable pricing power. That said, good businesses still attract competition. High-quality micro-assets remain scarce, and where there is genuine cash generation, defensibility, and growth optionality, buyers will still queue politely and then quietly fight in the car park. The key difference is that multiples now require justification. Stories alone are no longer sufficient. Investors want evidence, repeat customers, margin resilience, operational leverage, and something approaching a plan. Founders, for their part, are going through the stages of grief. Denial has mostly passed. Anger is ongoing. Bargaining is visible in the business plan. Acceptance is emerging, slowly. Deal flow, plenty of opportunities, fewer slam dunks. Deal flow in the micro-private capital market remains robust. There is no shortage of businesses seeking capital, partners, or exits. Demographics alone ensure this: aging founders, succession issues, and the realization that running a business indefinitely is less relaxing than it sounds. However, the quality of deal flow is more uneven. Many businesses are approaching the market earlier than they might have hoped, driven by cost pressures, slower growth, personal fatigue, the dawning realization that waiting for conditions to improve is not a strategy. This creates opportunity, but also risk. Investors must work harder to separate temporary dislocation from structural weakness. The due diligence burden has increased, and the days of "we'll fix it" post-deal optimism have been replaced with a desire to see at least some fixing before money changes hands. As a result, completion rates have fallen. More deals start, fewer finish. Advisors are busier than ever, but not necessarily happier. Capital providers, more disciplined, slightly older, still optimistic. On the capital supply side, the micro market is characterized by diversity rather than scale. Family offices, high net worth individuals, small funds, evergreen vehicles, and corporate offshoots all play a role. What has changed is tone. Capital providers are more cautious, more demanding, more focused on downside protection, less impressed by buzzwords. This is not because they have become mean-spirited, but because they have learned. Many have lived through one or two cycles and now understand that small businesses can surprise you, and not always pleasantly. That said, appetite remains. Micro-private capital still offers illiquidity premia, control or influence, tangible value creation opportunities, a sense of doing something real. In a world where much finance feels abstract, micro-investing remains refreshingly concrete. You can visit the business, meet the people, and see the machinery. This continues to attract patient capital, particularly from those who value involvement over volume. Structures, creativity returns, for better and worse. One interesting consequence of tighter conditions has been a resurgence of structural creativity. When price becomes harder to agree, structure steps in to help. Common features now include earnouts, vendor loan notes, ratchets, preferred equity, deferred consideration, performance-linked equity release. In theory, these mechanisms align interests and bridge valuation gaps. In practice, they often defer disagreement rather than resolve it. Still, they allow deals to proceed that otherwise might stall. The micro market has always been inventive in this regard, partly because it has to be. Standardized institutional terms often do not fit the realities of owner-managed businesses. The challenge is ensuring that complexity does not exceed comprehension, particularly when founders are encountering such structures for the first time. When lawyers become the only people who understand the deal, caution is advised. Value creation, less financial engineering, more actual work. Perhaps the most significant shift in the micro-private capital market is the renewed emphasis on genuine value creation. With leverage constrained and multiple expansion uncertain, returns increasingly depend on operational improvement, professionalization, pricing discipline, cost control, strategic focus. This plays to the strengths of micro-investors who bring experience, not just capital. Those able to support management, build teams, and impose light-touch governance are better positioned than those relying purely on financial mechanics. It also raises the bar. Passive capital is less welcome. Boards expect engagement. Founders expect help, even if they occasionally resist it. The micro market has always promised hands-on value creation. Now it actually has to deliver. Founders, between independence and exhaustion. The outlook for micro-private capital cannot be separated from the mindset of founders. They are, after all, the supply side of the asset class. Today's founders are conflicted. Many want liquidity, support, reduced personal risk. But they also want control, recognition, fair valuation, respect for what they have built. This creates tension. Micro-capital must navigate founder psychology as much as balance sheets. Deals succeed or fail as much on trust as on numbers. Encouragingly, there is growing sophistication among founders. Many now understand the trade-offs involved and approach capital as a partnership rather than a rescue. This bodes well for the market, though it does not eliminate emotional complexity. After all, this is often someone's life's work. Treating it purely as an asset is rarely wise. Technology and data, helpful, but not a panacea. Technology has made inroads into the micro-private capital market, particularly in sourcing, analysis, and reporting. Platforms promise efficiency, transparency, and insight. They deliver some of that. However, micro-businesses remain stubbornly analog in places. Data is incomplete, systems are inconsistent, and metrics are often interpreted creatively. No dashboard can fully capture the reality of a business where key decisions are made in the founder's head during a dog walk. Technology is therefore an enabler, not a replacement for judgment. The outlook favors those who combine tools with experience, rather than those who expect software to do the thinking for them. Regulation and compliance, the quiet creep. While the micro-private capital market is less regulated than larger institutional segments, regulatory and compliance expectations are slowly increasing. Anti-money laundering, know your customer requirements, and governance standards all impose friction. This disproportionately affects smaller players, for whom compliance is a cost center rather than a badge of legitimacy. Some will consolidate. Others will professionalize. A few will quietly exit. Overall, this trend favors scale and organization, but risks eroding the informality that once made the micro market nimble. The challenge is balancing rigor with pragmatism. Returns, lower, but more honest. Looking ahead, return expectations in the micro private capital market are moderating. The days of effortless double-digit IRRs from average assets are likely behind us, at least for now. Instead, returns will be more variable, more work-dependent, more closely tied to operational success. This is not necessarily negative. It encourages realism, alignment, and long-term thinking. It also filters out tourists who mistook micro-investing for a hobby. For those willing to engage deeply, returns remain attractive relative to risk, particularly when compared with more liquid alternatives. But they must be earned. The medium-term outlook, cautious optimism, properly earned. So what is the current outlook for the micro-private capital market? In short, it is alive. It is adapting. It is maturing. The market is becoming more disciplined, more selective, and more operationally focused. Capital is still available, but it is choosier. Deals still happen, but they take longer. Success still exists, but it is less accidental. Over the medium term, this should strengthen the ecosystem. Better businesses will be funded. Better partnerships will form. Poorer assets will struggle, but perhaps they always should have. There will be pain along the way. Some vehicles will underperform. Some investors will overestimate their appetite for involvement. Some founders will regret taking capital. This is normal. What matters is that the market remains flexible, human, and grounded in reality. Conclusion: small is still beautiful, just less forgiving. The micro-private capital market remains one of the most interesting, challenging, and oddly satisfying corners of finance. It sits close to real businesses, real people, and real outcomes. The current outlook is neither euphoric nor bleak. It is sober, demanding, and quietly hopeful. For those prepared to do the work, bring patience, and accept imperfection, opportunity remains abundant. Micro-capital has always rewarded judgment over formula, relationships over spreadsheets, and resilience over bravado. In today's environment, those qualities matter more than ever. Which, in a strange way, is reassuring.